August 19th, 2026, 2 p.m. Eastern. The U.S. Treasury Department puts out a routine-sounding line about its bond buyback program. No press conference, no breaking news cheering, just a line item saying the government would double the size of a debt operation most people have never heard of. 12 hours later, $4 billion in bearish crypto bets were wiped out. Bitcoin had its biggest single-day move since March, and the most levered Bitcoin bet on Wall Street, a position that had been bleeding for months, flipped from a $13 billion loss into profit in under 48 hours. Nobody explained the mechanism, so let's actually walk through it. Here's what changed. Treasury Secretary Scott Bessent announced the government would at least double its long-end bond buyback operations from $2 billion to at least $4 billion per operation, covering bonds in the 10 to 20-year and 20 to 30-year range. Effective September 9th, running through November 4th. The stated reason, in Treasury's own words, consistent strong sponsorship from market participants. Translation, dealers had been offering Treasury more bonds to buy than it was purchasing. There was room to buy more without straining the system. That's it. That's the whole announcement. No mention of Bitcoin. No mention of crypto at all. But watch what it did to the bond market first. The 30-year Treasury yield had just hit its highest level since 2007, 5.34%. The day before, driven by inflation worries, an escalating conflict overseas, and mounting concern about U.S. debt, which crossed $40 trillion that same week. Bessent's announcement pushed that yield down 9 basis points in a single day. The dollar weakened. And when long-term yields fall and the dollar weakens at the same time, capital doesn't just sit still. It goes looking for somewhere else to go. Bitcoin was one of the places it went. From an intraday low of $64,100, Bitcoin surged to a peak near $69,500, an 8.2 to 8.7% move, depending on which data provider you check, in under 12 hours. That was Bitcoin's biggest single-day move since March, and its first trip above $69,000 since early June. Here's the part that made it violent instead of just notable. Leverage traders had bet heavily that Bitcoin was stuck below $67,000. When it broke through, exchanges started force closing those positions automatically. Estimates of the damage range depending on the source. CoinDesk put forced short liquidations at $1.44 billion in the first hour alone. Other trackers cited figures as high as $3.50 to $4 billion across the full 24-hour window, one of the largest liquidation events on record. The Kobayashi letter estimated crypto markets added $280 billion in market cap in that single day, roughly $12 billion an hour. By Thursday, Bessent was on CNBC doubling down. "We want to show that yields do not reflect underlying fundamentals," he said. "We have a big toolkit." Bitcoin pushed towards $73,000 on those comments alone. A Treasury official talking about bonds, moving a crypto asset in real time. By Friday, the week closed at roughly $76,900 to $77,200, up around 23% from Monday's open near $62,800, according to multiple outlets. Though Bitcoin still remained well below its January 2026 high of $94,820 and its all-time high of $126,000. Now here's who actually benefited most from this, and it's not who you'd expect from the headlines. Michael Saylor Strategy, the company that turned corporate treasury management into a Bitcoin accumulation machine, had been having a brutal year. In May, Saylor broke his own never-sell pledge for the first time since 2022, unloading Bitcoin to cover preferred stock obligations. By June 30th, with Bitcoin down near $58,300, the company's unrealized loss on its Bitcoin stack had ballooned to roughly $13 billion, about 20% of its entire cost basis. The stock was underperforming the very ETF it was built to beat. Then Bitcoin crossed $75,385, Strategy's average purchase price on its 840,447 BTC. Above that line, the company's Bitcoin position went from a paper loss back to a paper profit. Not because Saylor bought more, not because the business changed, because a bond market operation nobody was watching move the number that determines whether his bet looks like genius or catastrophe. Here's what nobody's saying clearly. This was not quantitative easing, and treating it like magic money misses the actual mechanism. A bond buyback doesn't create new bank reserves and doesn't expand the money supply. If Treasury funds it by issuing short-term bills, it's a duration swap, trading long-term debt for short-term debt, not printing anything. It eases pressure on long yields. It does not shrink the $40 trillion debt pile by a single dollar. So why did Bitcoin treat it like a liquidity fire hose? Because the technical setup did the rest of the work. A market betting against Bitcoin below $67,000, sitting on billions in short leverage, needed only a small shove to trigger forced buying that looked like a much bigger move than the underlying policy justified. Which raises the question the market still hasn't answered. Was this real? Or was it a one-day trade that already reversed? By August 20th, the 30-year yield had climbed back to 5.24%, clawing back roughly half of the prior day's drop. The dollar recovered some of its losses, too. Mark Cuban, watching the same rally everyone else was celebrating, called it a short squeeze rather than a fundamentals-driven move. And the buyback expansion itself isn't permanent. It runs only through November 4th, after which Treasury reassesses. If long yields have stabilized by then, there's no guarantee the larger operation size continues. Here's what this actually means if you trade this market. A policy line item you'll never see trending got more leveraged shorts liquidated in one day than most news events manage in a month. The lesson isn't buy bonds news. It's that the biggest moves in Bitcoin right now aren't coming from crypto-specific catalysts at all. They're coming from the plumbing of the Treasury market, where a handful of basis points on a 30-year yield can do more to your position than any exchange listing or ETF filing. If you're sizing risk in this market without at least glancing at what the bond desk is doing, you're trading half the picture. The squeeze already happened. The 110,000 plus liquidated positions can't be liquidated twice. Whatever comes next has to come from real demand, not from traders who already got run over. So here's what I want to dig into next. Drop a comment and tell me which one. Do you want me to track what happens when this buyback program actually starts on September 9th and whether the real demand versus short squeeze question gets answered one way or the other? Do you want me to break down exactly how Strategy's cost basis works and what Bitcoin price would put Saylor back underwater if this reverses? Do you want me to go through the mechanics of a short squeeze step by step? How a leveraged bet turns into a forced liquidation cascade? Or do you want me to compare this move to the last 3 times a macro policy headline moved Bitcoin more than 5% in a day and see if there's an actual pattern? If this gave you the mechanism instead of just the headline, that's the whole point of this channel. Subscribe if you want more of the market explained instead of just reacted to. I'm Emma, and this is Emma Market Updates.